All right, so we're talking about goals and setting up a trust. And why are we doing that? Well, because it's so important to be clear as to why you want to set up a lifetime trust and who you intend to benefit, because it informs everything going forward, from the type of trust that needs to be set up, from the trustees who can act, from the assets that should fund the trust, and provisions that should be in the trust agreement. Now, what's so interesting is that you could have different goals and therefore need two different trusts. So you could have a goal of asset protection for certain reasons. And that means you need to set up an irrevocable trust. But let's say you also want to maintain control of certain assets. Let's say you own a business, but you want to put the business into trust. You're going to set up a revocable trust for that asset. So goals and what you want to do and assets, they're all always intermixing with each other, and you're coming up with the appropriate plan that works for you. So let's just run the scenario of setting up an irrevocable trust. So we have the asset protection goal. We're setting up an irrevocable trust. And let's say that as the settlor, the person setting up the trust, you will not be benefiting from the trust in any manner, okay? You may have other assets, you're going to benefit from those, but in regard to this irrevocable trust for setting up, you want to really set it in stone. You want to have this asset protection component, and you intend to benefit others. Who are those others? Well, let's just say here in this example, we want to benefit a child during his or her life, and upon his or her passing, we want to benefit B, a grandchild. So we're setting up the irrevocable trust. We're obtaining a separate tax ID number for the trust. And now we're thinking about the assets to fund this trust. So are we moving investment accounts into this irrevocable trust? Are we moving assets that will produce certain income? Are we moving assets that will produce certain capital gains? Are there capital gains maybe here and there, or are there capital gains every year to be pretty much expected? Or are we moving an asset that has low basis attributed to it, and there could very well be a sale of it during life or during the course of the trust administration, and we want to ensure that capital gains are going to be deemed part of the income that A can receive. So again, everything works together. So let's just run the scenario here. So we have the irrevocable trust, separate tax ID number, income to A for life, remainder to B. And let's say in a given calendar year, we have $15,000 in income. So dividend income, interest income. And let's say there are no trust expenses for that calendar year. And let's say there are also $3,000 in short-term capital gains. Let's say the trust agreement also provides authority for the trustee to invade principal for A's health, education, maintenance, and support. So let's say the trustee says, I see the $3,000 in short-term capital gains this year. I'm going to give those over to A. I can invade principal for A's benefit. I'm going to do it this year because of those short-term capital gains. What does A pick up on his personal income tax returns? A, unless there's something different in the trust agreement, picks up $15,000. And that's even though he's received $18,000. Now, is that fair to A and B? Well, who knows, right? We have to think about it. We have to see what the trust intentions are, what's stated in the trust agreement. But the trustee would have discretion to make an equitable adjustment according to statute. So there's a statute that provides for that. But let's just say that in that trust agreement, it was clearly written as to what should occur in regard to capital gains. Are capital gains to be deemed part of what's called the D&I computation, so that we don't have to concern ourselves with what the trustee may or may not do and this equitable adjustment and what the parties think? We can put that in the trust agreement. But it all does go back to goals and thinking about what are the intentions here, who's to benefit, and what assets are going into the trust, who's the trustee, and what is going to be the best moving forward as far as being clear on all of that. Now, let's just say that trustee took commissions in that same year of $1,000. Well, that would reduce what A has to pick up on his 1040. So let's just say trustee took $1,000, then that would reduce what the taxable income is to A by $1,000. Now, let's just say that there were no capital gains in that year, and let's just even say that the income was only $500 in the calendar year. The trustee could have a power to adjust as between principal and income and determine that it's one of those years that makes sense to do that. And that's another idea that we want to flesh out in the trust agreement, if at all possible. So I always say start with your goals and then move forward from there, because it's going to inform your estate planning attorney on some of the things to be looking into and the trust agreement and what to write into the trust agreement to be helpful going into the future. Now, I wanted to also just briefly talk about a quit claim deed where people quit claim their home to a child and retain a life estate interest. People forget that we never know the future, right? And we don't know if that home needs to be sold during life for whatever reason, or if the remainder and the children will have creditor issues, or if there's going to be some problem as far as their whole situation goes, whether they're going through a divorce, whether they may, unfortunately have some issues themselves, or they pass before the adult, before the parent. So we could put the home in an irrevocable trust, which has the asset protection component to it. But in that case, retain the social security number of the settlor as far as the whole taxation of the trust, and therefore keep intact the capital gain exclusion in regard to a sale of the principal residence during the parent's life. And this is something huge that people need to be aware about when setting up a trust like this. Because if there is a need at some point to sell their home and there isn't some other exclusion available, this can cause a lot of grief for people, realizing at that point in time, they're essentially stuck with potential capital gains, whether it's the remainderman, children, or the parent, or both, because you have to remember you've separated out ownership such that you have children as remaindermen, parent only receiving or retaining a life estate. And upon a sale of the home, remaindermen receive certain proceeds, life estate person receives certain proceeds, and each person to their own as far as what exemptions they may have available to them that would otherwise not be the case if, let's say, this kind of a trust was set up. So more to talk about there, but I just wanted to bring out this idea, always going back to goals. What are your goals? And think long-term, because going into the future, we don't have a crystal ball. We want to try and make it advantageous as possible for the people that we're trying to benefit. All right. So this is Ruth George with Ruth P. George Law, PLLC, Trusted Estate Attorney. This video, as with any video I do put out, is for educational purposes only. It does not establish an attorney-client relationship, and I look forward to seeing you on another video.